For more on what lies ahead, let's bring in Requisite Capital's Bryn Talkington, who's also a member of the Halftime Investment Committee. Toney, founding managing partner of Plexo Capital. It's great to have you on. Welcome to Overtime for the first time. It's great to see you as well.
Thanks for having me.
What do we take, from this DocuSign report and then the big stock slide? I mean, to me, it says that so many of these companies that did so very well during the pandemic aren't even close to adjusting to the other side or having their valuations be adjusted to what the other side looks like.
Without question. And we know that for these stocks in particular that are very dependent on their growth and future growth, we really value them based on that macro environment. So when we have these inflationary pressures, when interest rates rise, when we have the Fed reacting, when the outlook begins to decline for growth, that really punishes these stocks. Now, I would like to point out, however, if we really look at the fundamentals, especially the sentiment among CTOs, CIOs, and what their spend looks like, not much has changed there. In fact, one could even argue and make a case that a lot of these names, like DocuSign, especially some of these other names that provide infrastructure, other services for enterprises, actually could see spend by IT managers increase as they look to be able to reduce cost from people's salary cost, and increase efficiency for these people. So that's the irony, is that a lot of the fundamentals are still very positive for these stocks, but because of the way they're valued, they've been punished.
Bryn, it remains remarkable to me just how many of these companies, as I said, that did so well during the pandemic, Peloton, et cetera, you could find other names as well, just completely misjudged their businesses and the pull forward that they had, the spend that they made as a result because of what they thought the other side was going to look like. It's really astounding, frankly, that you're finding so many of these stories repeating themselves.
Yeah, I think with DocuSign, especially on the call, I think, management told us that they thought they were going to continue to grow at that same rate. And so they still have 1.24, I think, million users, of which about 15% are corporations. But management themselves misjudged that. And so I do think that's a bit astounding not to be able to look outside of the world and say, hey, you know what? So many people adopted that rate of growth is not going to continue. I will say, though, Scott, it's so important. Liquidity is so bad in this market. And so whether you're DocuSign, whether you're Target, which has nothing to do with, technology, if you miss or your guidance is off, the market's going to take you down 25%. And so I do think investors need to really understand how poor positioning is. And you're going to get, whether you're DocuSign or Target or Netflix or Facebook, 25% of your market cap is coming off if you under deliver. And so I think it's just a really difficult market, especially for DocuSign, which right now doesn't have an E. Right? They have good growth, but there's no E. And so there's another excuse to even not be able to value it and sell it down. I will say, though, okay, because I do think it's important. A lot of what's happening today is positioning. And so whereas we like to say, well, these high growth stocks, their earnings, they can't grow into their earnings for so many years. To me, the consumer staples continues to confound me. I was looking at, Clorox, Colgate, and P&G have a 2020 PE between 25 and 34. And so that's what's interesting about positioning right now. People want to own those names, but you know what? They have low earnings growth and high PEs, and people just don't want to own tech. And so until this changes, this is going to be that market, which will bring opportunity for investors, but it's certainly not today to be trying to catch the falling knife in some of these names.
Lastly, and quickly to you, where you make your bread and butter, venture. Has there already been the comeuppance in valuations, or is it still ongoing?
So it's beginning to trickle down, because for those later stage companies that have been raising growth rounds, they were raising at multiples that in some cases even surpassed what we saw in the public markets. we've already started to see a correction in valuations trending down. Now, that said, I think it's going to take a few more quarters for it to play out and trickle down all the way to the earlier stage, because many of these companies are so incredibly well capitalized because of the fundraising environment over the past 12 to 24 months that they don't have to go out into the market and test it. Now, that said, I think what we are going to see is we're going to see a lot of entrepreneurs surprised that even if they've been able to 4x their revenues, they still might face raising flat or even at a down valuation or with some structure in it to give some investors downside protection. At the earliest stages, pre-seed, seed, there's not too much wiggle room there. So we don't see too much compression. What we do see is we don't see those outliers anymore, those rounds that are in excess of 50 times, for example.
I'm sure there's some hard conversations being had. Lo, I appreciate your time. Bryn, you as well. Great weekend to you both, and I'll see you soon.